Welcome, and thank you for joining us to this new webinar hosted by Alquity. 2 months into 2025, markets are reacting to major political and economic shifts. President Trump's second term has brought new policies, trade disruption, and volatility. But how does this change affect our portfolios? Today, our portfolio managers, Mike Sell and Marnie Aragonwi, will share how Alquity funds are positioned, covering the impact of Trump's policy, positive but overlooked macro trends for emerging markets, and finally, how our flexible sector engaged strategy in the global impact funds adapt to this evolving landscape. We will wrap up this session with a Q&A. Let's get started. Mike, the floor is yours.
Great, thank you everybody. And on to the first slide, please, Mark. Before we get into the meat and bones of the presentation, let's just take a step back. Next slide, please, Mark. And let's look at how we at Alquity think about emerging markets. Now, this is not something that has changed in a post-Trump world, but it is something that is very pertinent for the world we now live in. We're highly different, and we focus predominantly in our Global Emerging Fund on domestic structural growth themes, and 69 of our 82 positions are domestically focused. These, by definition, are fundamentally more insulated from tariffs and so on. Also, we're very different from our peers and the ETF. 36 of our 82 names are not in the index. That gives us a differentiated source of alpha. And we're very diversified. We have 20 countries in our emerging fund. The characteristics of our funds are shown below. And what you see here is that we're compelling on all these metrics. We're cheaper than that of the index, and we have a higher ROE and faster earnings growth. So that is a standout characteristic in its own right. And we very much believe that domestic growth, non-traditional markets, and AI robotics beneficiaries will drive our portfolio over the coming weeks, months, and years. So now let's get into it. And on to the next slide, we have a map of the world and looking at Trump's impact. Red clearly means major impact, then we have yellow, and then we have green. Starting in North America, we have Mexico. Mexico clearly has been right in the firing line of tariffs that we've seen over the last couple of months, with news flow almost every single day. And we're very cautious on Mexico. Canada, interestingly, also has been even more perhaps in the firing line. As we move south, there is some sensitivity with Brazil in the sense that it impacts the exports of metals, steel and aluminium. But predominantly speaking, the economy is a very domestic economy and isn't particularly sensitive to Trump. Now, Brazil has its own problems. The economy is overheating and we're seeing rapid interest rate increases in contrast to the rest of the world. And so we're cautious there, but that's not for Trump reasons. And then in contrast, Argentina, President Milei is very good friends with Elon, with Trump. The reform that we've seen over several years is now bearing fruit. And this is an economy that very much does its own thing. Moving now towards Europe and Africa. South Africa, again, similarly, has limited direct exposure to North America. There is a free trade agreement that's coming up for renewal later in the year, and there will be some noise and sensitivity around that. But the domestic story outweighs that of the international one. Moving into the Gulf, Saudi, Kuwait, and Egypt, these are clearly green. Obviously, a lower oil price, which is what Trump seems to want, is on the face of it negative for some of these countries. However, for the UAE and for Saudi, we focus very much on the reform stories, domestic growth stories that are not oil linked. And Kuwait is something that we're beginning to take a look at for the first time in 10 years as another differentiated story. The EU is clearly very much in the firing line. We've seen that overnight with talk of tariffs on wine. We have positions in Greece and Poland. Again, they export very little to the US. And so we're very comfortable with what we have there. And obviously the UK seems to be slightly different in it, and that's why that's colored green. Moving east, then we have Russia. We'll have to see over the coming days just whether Putin is having a bromance with Trump or not. So that's obviously unclear. Then coming down into Asia, the standout positive is India, as we'll come on to in a moment. China, perhaps the big surprise here is China has not been more impacted. Obviously, they've had a couple of rounds of tariffs imposed against them, but Canada seems to be bearing the brunt of Trump rather than actually China. So not great for China, but actually perhaps not as bad as feared. And there's certainly some interesting stories there, as we'll see. Korea and Taiwan, again, potentially issues there given the export side. We only have really exposure to AI and tech beneficiaries. These are very price inelastic. And so again, we think that the demand drivers, which are only accelerating, are going to outweigh any negative impact. In ASEAN, most of it is very fine in this environment. The Philippines and Indonesia have very little exports to the US. A little bit more for Thailand and Malaysia, but generally for those four countries, the key driver is the dollar. And if Trump wants, as he seems to want, a weaker dollar, then very much these countries will do well. The domestic growth story is strengthening. We're seeing reform, but that's being overshadowed by the dollar. And as soon as that stops, then these are like a coiled spring ready to bounce. The only exception is that of Vietnam, where, like with Mexico, a third of GDP is accounted for by exports to the US. Vietnam hasn't been mentioned yet by Trump, but has many of the characteristics that other countries who have been attacked by him have. And so we're somewhat cautious on Vietnam. So now let's delve into this into a little bit more detail. And let's start with China on the next slide. China is 22% of the Future World, our GEM fund portfolio. And we can find great private sector companies that are not linked to either geopolitics concerns or to concerns about tariffs or exporters. So starting firstly with technology, and the DeepSeek release a few weeks ago has supercharged that sector. And somewhere like Tencent has done incredibly well. And there's other companies in that space like Meituan, Full Truck Alliance, that also are really exciting opportunities. Elsewhere, the Chinese clearly want to offset the impact of tariffs with stimulus. And that's really positive for the consumer sector, whether that's Robam or Yum, or indeed at the top where we have travel companies like Trip.com or Tongcheng. So although China has a number of headwinds, there are also some tailwinds, and it's a more nuanced position. The key here is to have an appropriately risk-weighted portfolio and only focus on well-run companies that are private sector, not linked to the state, not linked to tariffs, not linked to geopolitics. Moving on now onto India, the story is much, much more clear-cut and hugely positive. India is about 19% of the fund, and exports to the USA for India are only 2.7% of GDP. And exports are not the growth driver for India, in contrast to other markets. It's about domestic growth, the demographics, the shift to the formal sector. So areas that we like, financing India. So companies like Aptus or Mahindra Finance are really geared to the rural economy, which is looking the strongest it's been for many years. Leisure, hotels, online travel agencies, we're seeing very strong bottom line growth there. That's incredibly consistent. It's one of the most important and powerful structural stories in a market that's full of really good structural stories. Building India, Lodha or Polycab, these benefit from lower interest rates that we've now started seeing come through in India. And organized retail at the top, companies like Aditya Vision, in North India are focusing on pent-up demand for electronics goods. A few years ago, there wasn't good quality electric supply that was there 24 hours. There was no point buying a TV because you couldn't watch it all the time. That's now changed, and there's wealth in these areas, and it's playing catch up to the rest of India. And companies like Aditya Vision really benefit from that. But the message here is every one of these stories that I've told you about, none of them have any sensitivity to what's going on globally. And the recent correction in India, which we think is unjustified, perhaps provides an interesting opportunity. So moving on to the next slide, let's go through one of these Indian companies in a little bit more detail to really give a sense of why we're so excited. This is Ixigo, a market cap of about $650 million, out of index, listed in the middle of last year. And it's an online travel agency. We have really strong structural growth there, as you can see on the right-hand side in terms of projections, whether that's air travel, hotels, rail, bus. It's a secular growth story. People have more money, they have more leisure time, and Modi's infrastructure investments are bearing fruit. You now can easily go away for a weekend and have a vacation, etc. Ixigo is the second largest in India, but it focuses more on the smaller cities. That's why it's the OTA for the next billion users. They have 480 million annual active users. That's more than the population of the US or Europe. It's a huge number and a massive potential. And it's highly differentiated versus its peers with some of its features. ESG is really important to what we do, and in our own proprietary rating system, we rate this company a C. Moving now to Eastern Europe on the next slide. This is Budimex. Again, this is a Polish company, 3 billion market cap, out of index, and it's a local construction champion. Really strong track record over decades of successfully delivering projects. And it benefits from favorable cyclical tailwinds due to a lot of EU funding coming into Poland. Again, completely domestically driven. We see a lot of upside in our DCF forecast, almost 50%. But interestingly, this could be a beneficiary, a very clear one, of Trump coming to power, as they very much do the reconstruction of Ukraine. They've done work there in the past. And that is something that they're investigating more. So if we do have a ceasefire, if we do have a peace treaty, then this is a beneficiary, and it's a B in terms of ESG. Now, on the next slide, we talk about a couple of consumer companies. The power of the domestic consumer is a key driver for our portfolio. In Egypt, we have Editar, which is a bakery. It's the largest one in Egypt. Leading market share in cakes, croissants, significant pricing power. Egypt has a young population of 114 million people. It's a big country, and it's had a lot of hard times economically, which it's now coming out of. Inflation there actually halved year on year in the last month. Editar has been around for decades. It's beginning to expand regionally, for example, Morocco and Iraq. Again, out of index, 400 million market cap, a B rating for ESG. Moving to South Africa, the retail sector here has Boxer, which is a recent IPO, 1.7 billion market cap, C for ESG, and it's the leading discount supermarket, gaining consistent market share from other companies and other formats. Entirely domestically driven, and has about 500 stores and expanding considerably. So these are some of the really exciting stories in the portfolio. And on the next slide, given that we have these domestic growth stories at the micro level, let's now look at what's going on at the macro level in emerging markets. Because again, here, there's a lot of unappreciated good news that is being masked by the daily Trump headlines. So whether the Fed raises rates, cuts rates, whatever, we have interest rate cuts that have already happened this year in India, Thailand, South Africa, etc. Reform is having a positive effect, and success is coming through, as I mentioned, in Argentina and Egypt. Growth is strong, 5% in Q4 for Indonesia, a bit more in the Philippines, 4.4% in Saudi, and even 3% in the EU in Poland. Greece has had a lot of problems that have been well publicized over the last couple of decades. But Greek unemployment fell to a 15-year low in January. Again, these are off the radar screen, but this is where we can find uncorrelated, powerful alpha stories. China, obviously 20% of the funds, again, focusing on 5% GDP growth this year with increased fiscal spending, which is good for the consumer. India's weak growth in 5.4% in Q3 is now behind us. 6.2 in the last quarter, and that's before we've seen the impact of the giveaway budget and the monetary stimulus that with the first interest rate cut. I'm just back from meeting 40 companies in India over the last couple of weeks, and very clearly what those companies are saying very much chimes with our view that we have an improving economy and the market concerns about growth are false. Inflation is pretty low across emerging markets, whether that's ASEAN, Taiwan, Greece, the Gulf, India, and no issues there. And where we do have some international exposure, such as the AI beneficiaries in Korea and Taiwan, demand for this is in the really early stages. So this again is a multi-year structural story. So we have great and exciting micro. We have really good macro. But on the next slide, you can see that we're really cheap. This is showing the trailing price to book of emerging versus developed over 20 plus years. We've never been this cheap. And you could have said that a few points in the past. But as investors are increasingly looking about diversification, particularly given what's happened in the US so far this year, and we're certainly seeing investor inquiries along those lines, and given you've seen the returns of Europe, the UK, the US over the last 3 years, which have been pretty strong, and emerging has lagged dramatically. So we have the micro, we have the macro, we have an unloved asset class that's really cheap. And for people looking for diversification in domestic growth stories, then emerging does have something very contrarian to offer. And on the next slide, just to emphasize this point, we're really unloved. This is flows into emerging markets. We saw an outflow in 2019, a small in 2020. Then 2021 was a really strong year. Sentiment turned very quickly in emerging. Since then, it's been flat to weak last year, again, weak this year. So when people are looking for other alpha opportunities that are not fundamentally linked to what's going on in the US and have lagged, but have a really good macro and micro story with valuation support, then for those that want to be contrarian and go against the herd, this is something that we think is really interesting to have on the radar screen. Now on to the next slide. How have we done in this environment? Well, we believe that our long-term perspective and our in-depth knowledge really delivers the results. And since we enhanced the process and streamlined the team almost 5 years ago, August 2020, we've consistently beaten the ETF and we've consistently beaten the peer group. Over 1 year, that's been even more magnified. And obviously we have a good 4 or 5 months of Trump in there now. And so this is how we've navigated that environment successfully. Despite looking nothing like the index, we have a lower volatility than the index. And we believe the secret of our success is that greater focus on structural themes, domestic growth, quality growth across the region, regardless of market cap or whether it's in the index. We also have a lower environmental footprint, and ESG is really critical for us as a risk mitigation tool and a way to generate alpha. So to sum up on the emerging side on the next slide, sentiment in our view is overly bearish on emerging and India. Our portfolios are very different, multi-cap approach. We focus predominantly on domestic structural growth, plus some AI beneficiaries, which also are a structural story. ESG is a critical tool for us. We deliver tangible impact and we have a strong and consistent track record. And we're really excited, I hope you can tell, about the opportunities that emerging markets offer over the coming months and years. So thank you very much. I'd like to hand over to Marnie, and then I'll come back for Q&A at the end.
Good afternoon, everyone. I really would like to thank everyone for being here today on a late Friday afternoon. What I'd like to do today is three things. For those of you who are unfamiliar with the Global Impact Fund, I think the best way to demonstrate how we are best poised to navigate this volatility is to give you a short description of what we do as a fund and how we navigate that volatility. The other thing that I'd like to do is that if you went back to November of 2024, I think we would be in a place where the turn of events to today, March 14, 2025, is something that no one could have forecasted. And I'd like to take you through those events starting from when Trump was elected up to the end of February. And a lot has happened since in the 14 days that we have in March. And it's a reminder of how it is incredibly difficult to try to understand how the future will turn out. I'd also like to, as a final turn, give you an understanding of how we as a fund have navigated those events and how we're best poised to manage the volatility going forward. So very simply, I'd like to turn to this first slide, which is a fund overview. The Global Impact Fund is a diversified global equity strategy, and that's really quite important because in this global equity strategy, we're able to diversify across borders and across industries. And so we can take opportunities not only in the United States, but in Europe, in Japan, as well as emerging markets. And that breadth of opportunities is quite key to managing today's volatility. We seek to outperform the relevant benchmark and peer groups, and we'll go through some return statistics, which will tell you how that we've exactly done that. And we invest in companies that provide products or services that benefit society or produce them in a responsible manner. So we are an Article 9 fund, and that is part of our DNA. We not only seek to outperform the relevant benchmark and peer groups, but we also want to help create a sustainable society. So even though that may seem out of favor currently, we have been able to navigate that volatility quite well and remain one of the best in our Article 9 peer group and in our global equity peer group as well. So what's really key to how we've done that is that we have a flexible investment strategy. And I'd like to emphasize that it uses advanced data analysis and a systematic approach. And those two things have been able to capture alpha opportunities while managing risks. What it emphasizes is adaptability, quick decision-making, and responsiveness to market changes. The fund invests only in sustainable companies. We invest in companies with at least 5% in sustainable revenues, and typically half of the portfolio is invested in companies with more than 20% in sustainable revenues. So although you may think that 5% is quite low, we're really quite strict as to how we define sustainable revenues, and we need to have third-party verification. So even though there may be about 3,000 companies, our investable universe, that number quickly drops down to about 400 because of that strict definition of sustainable revenues and our high-quality screening of ESG companies. So if you move on to the next slide. Our core investment approach invests across the growth and value spectrum. And this is a systematic approach that ensures that the portfolio captures evolving market themes and opportunities. What I'd like to do is contrast that with a more fundamental thematic approach to investing, which you might all be familiar with. So unlike a fundamental approach, the fund does not stick to a prescribed investment style or strategy. What we aim for is a consistency of returns versus the benchmark. Hence, we do not tolerate long periods of underperformance until a style works. It moves away from long periodic performance reviews, such as annually, and instead we integrate daily assessments of performance and risk. And how do we do that? we use advanced statistical analysis to analyze that market data and stay ahead of trends. So in this way, when the market swings, we avoid impulsive decisions and human biases, and these include overconfidence, herd mentality, and recency bias, which can exaggerate performance on both the upside and the downside. So in the next slide, what I'd like to emphasize that because this is a global sustainable fund, it is not a thematic fund, and hence it is not a satellite strategy. So we are complementary and differentiated because we are a core part of your global equity allocation rather than being a satellite allocation. So in the next slide, I'd like to show you how we have performed. And this is really quite evidence of the investment process that we have in place. What you have here is the 1 year, 2 year, 3 year, and since inception. If you look at the 2 year, 3 year, and since inception, which are our longer term measures of performance, we have consistently ranked very, very well with our peer median. So that includes all the global equity funds, as well as just Article 9. What you see in the 1 year is a slight lag because of the last 2 months of 2024, but we have quickly addressed that. So based on our numbers year to date, we are now again back in that second quartile and that first quartile for the Article 9 peers. Okay. But I think what I'd like to demonstrate, and that really brings this to home, is that if you look at the right, we have our risk statistics. And you can see clearly that in our Sharpe ratio, we have it is higher than our peer median or Article 9. And it's evidence that we have deployed risk very efficiently in order to generate those returns. We do it at quite a low tracking error versus equity, and our maximum drawdown is better than what we have for our Article 9 and for our global equity peer median. So what I'd like to walk you through is the market events that have happened, starting with the Trump election. So if you could move to the next slide. I just want to go through this quickly, but it's a good reminder of how sentiment has turned very, very quickly in the markets. So we start off in November 2024, and if you see here on the right, you have the performance of various markets. First, we'll show you the growth versus value, developed market equities versus emerging markets. And then we have much more regional or market cap breakdowns. Europe, small cap equities, Asia Pac ex-Japan, Japan, the United States, the Magnificent Seven, and China. So as you can see, in November 2024, when Trump was elected, the specter of Trump's tariffs and very much a pro-growth environment in the United States led to growth and small cap stocks outperforming. The United States broadly outperforms, and regions such as China and emerging market equities are hit quite hard because of that specter of Trump's tariffs. By December, we had a hawkish Fed, and the inflation print was quite negative in December and in January, and this led to steep declines across markets. What had been surprising is that China adopted a pro-growth tone in high-level economic meetings, and Europe was further plagued by political uncertainty. So in December, US spread narrows, and small cap gives back almost all gains from the Trump rally. Okay, so moving on to 2025, what have we seen? Let's go to the next slide. So 2025, this is really of more recent memory. And if you recall, in January 2025, the DeepSeek chatbot was released. And US exceptionalism starts to lose its shine. There is also increasing uncertainty about Trump's policy agenda. So there are 3 things that really were hit: the artificial intelligence play, growth stocks, because there's concerns on growth start to reemerge, and what really happened to the United States because of this policy agenda. So what we see is there a now rotation from growth into value. Developed market equities outperform, but it's not because of the United States. It's because Europe lacked AI names. And positive macro data, particularly from south of Europe, start to come through. In this scenario, European financials outperformed with superior ROEs than their US counterparts. There is extreme excitement about DeepSeek, and there are high-profile meetings between Xi and business leaders. And something that no one would have foreseen, Chinese tech outperforms. And despite the falling yields that we have globally, small cap underperforms. So this is a very, very deep rotation. And we see that further reinforced in February, and we actually see it a lot more reinforced year to date in March. As you probably know, the recent headlines have shown that in 16 days, the S&P 500 has hit correction territory. So the first 14 days of March have actually been quite different from what you see in November and in December, and to some degree, January. So how has the fund outperformed? And we can take a look through that. First is that this European value rotation has alleviated negative sentiment towards sustainability. And I give you the Sustainable Development Index at the bottom of this table. What I want to highlight are two things. What has been the performance of markets since the Trump election? And what has it been year to date through February? March isn't reflected in these numbers yet. So while we can see that growth has still outperformed value since the Trump election, we see a huge reversal of that from year-to-date numbers and a further reinforcement through March. Developed market equities, similarly, has outperformed, but you see in the year-to-date numbers, they're actually neck to neck. And I believe year-to-date through March, emerging has now outperformed developed markets. In Europe, it has become the best performing market. And small cap equities really has added no value, actually even giving back returns for the period of March 2025. What's been a very stable environment has been Japan, and no one has been talking about Japan. But as you see here, it's been quite a sweet spot in terms of volatility. What we also see in the United States of Magnificent Seven is that there is a lot of outperformance coming from Magnificent Seven, but a huge give back year to date. And China has remained the best performing market for both since the Trump election and year to date. And you can see here again a reversal of fortunes in the Sustainable Development Index. And all of these really will come into play as to how we have positioned the fund to take advantage of all these changes. So if you can move to the next slide. So one telling feature of the fund is that we avoid the sector bias of not just Article 9 peers, but also our global equities peers. Most of our peers now have quite a meaningful overweight to probably 4 sectors: technology, industrials, utilities, and materials. And you see here in the gray line, so we have 2 competitors, Clean Economy and Global Climate, where there is an overwhelming overweight to those sectors. What you'll find in the Global Impact Fund, which is the green lines, the aquamarine bars, is that we are actually much more diverse in how we are positioned in terms of sector positioning. And that is quite key to how we manage the volatility. In the next slide, what I'd like to show you is it's not just the diversified sector positioning that helps the fund, but it's that quick ability to respond to market changes. And I have 3 scenarios here, where in November and December, we actually saw the Magnificent Seven rallying, and consumer discretionary, which this fund being a sustainable fund would have an underweight to, also rallied, especially in November. And how do we address that underweight? We try to address that underweight by replicating beta. And so we find opportunities where there is quite high correlations and similar volatilities, but yet have sustainability. And those are names such as Salesforce and ServiceNow, which exhibit those characteristics. And that has helped us outperform during the period. We also saw a negative sustainability sentiment as a reversal of the CHIPS Act, and a negative sentiment coming from ESG and sustainability came through, especially in the United States. And what we did was to shift from renewable energy companies into domestic industrials that should benefit from Trump policy. And these are increasing our weightings in Steel Dynamics, which is a metals recycling company, and Aptiv, which is an auto parts company that not only creates parts for electric vehicles, but also other vehicles as well. But an overwhelming part of what they do is electric vehicles. And these two companies should benefit from domestic support. What we also saw from our proprietary framework in terms of finding good companies to buy is the European drawdown in December and November allowed us to buy value companies that should outperform. And these are companies such as Mercedes-Benz and D'Ieteren Group in Belgium, which are both consumer discretionary and automobile companies. And these should benefit from those cheap valuations and an eventual bounce in Europe, as we will see. So in the next slide, what I want to focus more is what has happened year to date. We had an AI drawdown. And while we hold high quality companies such as NVIDIA and Broadcom, that extreme drawdown actually quickly helped us to refocus the portfolio so that we would focus on Trump policy beneficiaries. And the dominant domestic chips producer in the United States is Intel. And Intel has not had the same drawdown that we saw in the other chips companies as well. And increasing that weight to Intel tactically has helped performance. What we also did with Broadcom and NVIDIA, as they posted an extreme drawdown, was that we actually bought more of the company. And so with a subsequent bounce in early February, we were able to benefit from that and subsequently reduced our allocations to both companies. What we also saw was that the falling yields environment and positive growth benefited two things: non-US financials and real estate. So we also quickly pivoted to buying non-US financials such as Itaú in Brazil, Mitsubishi UFJ in Japan, and Intesa Sanpaolo in Italy. And with the recent bounce, we've actually reduced our allocations to Itaú and Intesa Sanpaolo. We also bought tactically Aldar, a real estate company in the UAE. In terms of Chinese tech, we increased our exposure also tactically to Chinese tech companies, Tencent and Kingdee. And we've really benefited from the bounce in those names as well. I think what's more compelling is that we basically rotated our exposure from being a pro-growth bias in late 2024 to a pro-value bias year to date. So we reduced our Magnificent 7 beta, and we have focused much more on domestic industrials and basically consumer staples. So we have an overweight to Gilead Sciences as well as American Water, and Gilead, if you're not familiar with it, is a biotech company, and American Water is a utility company, and both have benefited from this new focus on value and domestic industrials. So in our next slide, what I'd like to do is really just give you a good sense of the future is quite unclear. What we do know is that a trade war has started, but the twists and turns, it's extremely unclear. What we also know is that Europe seems to be poised to outperform, partly from the defense and infrastructure spending that will happen, right? As well as prospects of a peace deal in Ukraine. The United Kingdom is likely to outperform because they are shielded from tariffs. We also like Japan a lot more based on its positive growth story. But I'd like to understand is that we are dynamic and data-driven, and we will understand on a daily basis how correlations and volatilities are evolving and position the fund appropriately. And our ESG dashboard is our compass. It guides us to investments that align with protecting shareholders' interests. And this really helps to have a quality tilt in our companies through this volatility. So what I'd like to do is pass it now to Mark for further questions from here.
Thank you very much, Marnie. So we start now the Q&A session. So you know the principle, you can write them in the Q&A tab at the bottom of your screen. And I think the first question, and I think it's quite linked with what you were saying, Marnie, how do you find correlation and how do you play when actually different stocks are rallying?
So if I understand the question correctly, is that how do we do all this, right? How do we
Yes.
actually find the volatilities and those correlations? On a daily basis, we actually look at prices for 3,000 securities. So it's not only our investment universe, but overall how the entire investment universe is moving. On a daily basis, we do a statistical analysis through proprietary quantitative methods that break down the volatility and correlation of each stock, and then be able to identify collectively what are the different directions that momentum, that growth, that value momentum, and volatility are playing out, okay? We look at the overall momentum of the index and understand how we can best, well, poised to capture the volatility of that market, yet identify stocks that rank the best among those equity factors. So on a daily basis, we do that. And then we're able to spot what are the best ways to mimic risk as well as to outperform. Those volatilities are evolving. So what we do is rebalance once a month on the minimum level. But when we see that risks are moving by at least 20%, then it's a signal for us to start looking at how the markets are changing, and perhaps to understand how those factors are changing and rebalance or tactically increase or reduce exposure as data is changing.
Thanks, Marnie. And we have a follow-up question on that because obviously sustainability data is quite tough. So how do you find the quality of them? Where do you find them? What database do you use? And maybe after we can extend the question also to Mike in EM.
Yeah, absolutely. And that's a really relevant question for emerging markets. We find that developed markets data is quite deep and updated and much more clear than where we were 5 years ago, right? So we use 3 sources of data. We use MSCI, Sustainalytics, as well as Bloomberg. And looking at those different data, we actually use thousands of data points and then identify 42 factors by which we can rank the ESG quality and sustainability of our stocks. So that's the first way that we actually source sustainability and ESG data. Aside from that, we also look at controversies through various news media, as well as artificial intelligence supported data feeds that give us a good sense of how controversies are moving. So for a stock, for example, like Apple, that may be ranked well in terms of ESG and sustainability, we have to fail Apple because there are certain controversies associated with their labor that are unacceptable to us, okay? In emerging markets, it's much more difficult. We're not finding that the data is updated as much as we'd like, and it's unclear. So we need to have Mike and the emerging markets team to filter that information for us to understand those markets well and be able to give us what are the best ESG quality companies and what are the controversies that we need to be aware of.
Thanks, Marnie. A question for both of you, so you decide which one answer the first. Do you think the dollar will continue to weaken this year? And if so, how much of a tailwind do you expect that to be on the future world and the GIFT strategy? Who do you want to start? Mike, Marnie?
Mike, would you like to start?
Okay. So I think the common theme this year is going to be volatility and unpredictability, and that gives opportunities. My view is that a adequate diversification of assets, whether that's within the Future World Fund 80 companies, 20 countries, or whether in GIF, as Marnie has talked about, is going to be the secret to good success in the next couple of years. Now, I think the headlines on whether the dollar is going to be weak or strong varies by the day or by the hour. And it very much depends in which way the Trump administration goes. Now, that a weaker dollar is not priced into emerging markets. If that does happen, then we will see a very powerful rally, given how unloved and how cheap we were, as I talked about in my presentation. If it doesn't happen, then the fundamentals of most of our markets, the structural growth stories, whether that's travel, whether it's supermarkets, etc., will come to the fore. So in sum, I don't think anyone can tell you with any certainty what will happen, because it is about volatility, and therefore having a good spread of assets and having a really favorable risk reward, which is what you have in emerging markets, it is the right strategy. And if it does happen, then we will see, in my view, a very, very powerful rally that's not priced in.
Thanks, Mike. Are you thought that the recent sell-off in US is a short-term correction or start of a longer-term downtrend? Maybe, Marnie, you can answer this one, and we will extend to Indian equities about with the same question for Mike.
I think that what we've seen is something that I think was completely unexpected, in November 2024, and the pace at which it has happened is very surprising to everyone. We're now at a point where it feels like recession is slowly being priced in, right? And talks of stagflation have been in the headlines. It's very, very difficult to see at this point. This really is, at this point, a very important pivot point for the United States, right? If anything, the urgency of a Fed or Trump put is what may be needed to turn this around. But the likelihood of that is up in the air. Nobody is uncertain. Nobody really knows how that is going to happen, and if it will happen. So it's not. It's very unclear, and I think that what would happen is that if indeed this drawdown in assets happens in the States, both the emerging markets and the Global Impact Fund stand to benefit from it, right? And if indeed it doesn't happen, I think that the ability to quickly pivot from the Global Impact Fund and the focus on AI companies as well as domestic equities in the Emerging Markets Fund barbells the risk profile quite nicely in emerging markets. So in my own opinion, it's slightly more to the downside from what we're seeing, but that can quickly change just depending on what Trump does, right? So Mike, I don't know if you have a different opinion.
Not at all. But I think you again hit the nail on the head, where it's, the moves in markets this year have been completely unexpected if you go back 3 months, which brings us again back to things that are unloved and unfairly unloved, and also the benefits of diversification. So I would agree. In terms of India, the weakness in the Indian market, in our view, is entirely unjustified. India has been concerned about a growth scare, which is not true. We already have seen growth accelerating, and that's before the impact, as I mentioned, of the interest rate cuts and the tax cuts in the budget. Obviously, global sentiment hasn't been helpful to that, but given India's uncorrelated nature, both in terms of stock market and in terms of GDP drivers, we think this is one of those blips that you get in India periodically, once every few years. And for the long-term investor, given that the fundamentals remain intact and indeed very strong, could present an interesting opportunity.
Thanks, Mike. So the natural question from that is, do you prefer actually GEM or India?
That's a tough question, but it's not an either or. We think GEM is cheap, unloved, and there are 20 countries and 80 odd stocks that have really powerful growth drivers that are 90% domestic. So for those investors that want a broad multi-country exposure, then that is the one. Within that, India, without any doubt, is the largest good story within emerging markets. It's big enough and liquid enough to have a standalone allocation. And so we would think that many people would want a core and satellite approach using both Future World and India. But it really isn't either or. But within an emerging context, India is the big, great story, but there's really powerful things in Saudi or Egypt or Greece as well. So it's horses for courses. Certainly both would probably give you a better alpha profile, in my view, over the medium term.
Thanks, Mike. Last question, and I think it will be for both of you. You got strong performance. If you had to illustrate it with one stock, one example, what will it be, Mike or Marnie?
So I think last year, one of our stocks that perhaps encapsulates what we do in just one name, I'd like to give the example of Despegar. Despegar is a Latin American online travel agency. Again, this is something that's not in the index. It's ignored by many investors, therefore. And it benefits from the secular and structural trends of people having more leisure time and traveling more in Latin America, but also the shift from the physical to the online economy. Also, it was incredibly cheap. It was trading at a fraction of other international or emerging market online travel agencies. We met management. The ESG was good. And that was a stock that we had one of our largest positions in the portfolio. Sadly, well, good but bad as well, it got taken out and bought out by another company towards the end of last year. So we unfortunately had to exit it. But obviously they saw what we saw as well, which was an incredibly powerful multi-year structural story. So that would probably encapsulate the kind of thing that we look for. Hidden gems, out of index, attractive valuations, structural domestic stories.
And what about you, Marnie?
I think the poster child for understanding how we actually work is probably Intel. You know, very much unloved before November 2024. We really had no position in Intel because of the extreme volatility that it was bringing. We only established positions opportunistically in Intel as it cheapened and then quickly got out because of the volatility that we had. What we've found is that it's been a great example of how we position the fund to take advantage of trends. It quickly became sort of like the value poster child in artificial intelligence and now the growth poster child. And what has happened? The Trump domestic policies that have really wanted to support domestic AI companies. Fine, the CHIPS Act was rolled back, but there has been a lot more conversations between Intel and Trump than any other chip company out there. And a massive rally of 20% since Trump took office. We quickly took some chips off the table, right, in order to rotate that exposure to something else, whether that's Chinese tech or Europe. So we have actually a lower exposure to Intel right now, and it has, you know, with this announcement of a new CEO, it rallied 10%, I believe, yesterday. We took some chips off before this rally, but because we want to ensure that we can find other things in the portfolio that work, because as I've said, diversification is key. So if I had to choose one stock, it would be that one.
Thanks, Marnie. I wanted to wrap up, but we have a really interesting question, so I will ask it. So with the EU and the UK boosting defense spending, the FCA stated that their sustainable labels don't prohibit investment in defense companies as a means to boost defense spending. Firstly, what are your views on this as sustainable? Maybe Marnie. And secondly, have defense stocks also risen in GEM? And it will be for you, Mike, please.
So the Alquity ethos is that we will invest in sustainability and hence armaments and defense is a negative screen for us, right? This has been the classic case of what happened in 2021, or rather 2022, when Russia invaded Ukraine, and energy was an outperformer. What we aim to do and what we have done is, like in 2022, where energy is considered uninvestable for us, we pivoted our companies towards food companies, sustainable food companies that benefited from the growing concerns about breadbasket in Ukraine. And we actually outperformed everyone that year. What we're finding this year is that infrastructure companies and financials are outperforming in the same way that defense companies are outperforming. And the ability to capture that positive correlation is how we positioned the fund to take advantage of this change in trend and opportunities available in the true sustainable universe.
I mean, I would just add to that there's a very wide range of views amongst our client base on this, and some would agree with the FCA and some wouldn't. From an emerging point of view, they have gone up, but there's a very, very few. There's a couple in the index, and there's only a handful of listed companies. So it really doesn't make any difference whatsoever for us in terms of performance. So for us in emerging, it's much more of a moral question than a practical portfolio performance question.